Hey friends, Lucian here with the Bullish Bears team. This video is going to be about selling options. So in the world of options, a stock option gives an investor the right, but not the obligation to buy or sell a stock at an agreed upon price and date. Now, every options contract requires both a buyer and also a seller. In this contract that's being formed, the buyer has the rights and the seller has the obligation. So in this process of entering into an options contract, sellers, they collect the premium. Buyers pay a premium. So if you're an options buyer, you're paying a premium to enter into that contract to an options seller. So the options seller is collecting the premium, the buyer is paying the premium. Now, just like any trading strategy, there are positives and negatives of being an options seller. So I want to talk to you about the risks associated with selling naked options. So naked options, again, we'll start with on the buying side. If you're an options buyer, if you buy calls or buy puts and you're buying them by themselves, those are naked options. That's the same thing with selling options. If you sell a call or sell a put by itself, you're selling naked. So if you're selling a naked call, you're bearish on a stock. If you're selling a naked put, you're bullish on a stock. Whereas if you're buying options, right, if you buy a call, you're bullish. If you buy a put, you're bearish. Just kind of flips around when you're selling options. You sell a call, right? So you sell a call if you're bearish, you're selling that call to somebody that is bullish, right? So if you're selling a put, you're selling it to somebody that is bullish on the other side. Now, it's very important with naked options. You want to be very careful selling naked options because there's enormous risk. Whereas, when you're buying naked calls and puts, there's limited risk on what you'll lose. You lose what you enter, the price of the premium that you pay to enter into the trade. When you're selling calls and puts, the risk is a lot more huge. Let's take a look at a couple of examples and I'll show you the risk. So this right here is showing an example of selling a naked call. So you can see here the max profit is $355 on this trade, selling a naked call of Apple, right? I was just selling the 114 at the money strike price. Now, if you look at the loss when you're selling a call, it's infinite. Because when you're selling a call, you're bearish. Now, that means the stock, again, could go to infinity. The chances of that happening, again, it's not like it's going to go infinite, but the loss or the max loss is infinite because a stock can go to the moon, right? So it can go, there's no ceiling on how high a stock can go. So if you're selling that call to an options buyer naked, there's unlimited amount of loss that you can take on that trade if you're being an option seller of a call. Now let's take a look on the other side if you're selling a put, right? So when you're selling a put, you're bullish on the stock where the buyer is bearish on the other side. So you'll see here max profit around 380 bucks. The max loss is more capped, but as you can still see, it's a huge amount that you can still lose because, again, if you're selling a put, a stock can't go below zero. So while the losses are capped, they're still way huger than being an options buyer and just buying naked calls and puts. So the risks associated with being an options seller when selling naked are huge. So while the risks associated with selling naked calls and puts are huge, there are tremendous benefits to taking that strategy of selling naked calls and puts and putting them into spreads known as credit spreads. All right, there are several different selling strategies that you can do. I'm just going to kind of touch right here on selling credit spreads because they're a very popular strategy where you can, sell, spreads or, sell to an options buyer, collect a premium. There's a time and a place to do them. But again, credit spreads, there's two major or most popular spreads to do. There are call credit spreads and then put credit spreads. So a call credit spread, it's a combination of, selling and buying an options contract. Same thing with a put credit spread. So you're doing a combination of selling and buying. You're doing with a call credit spread, you're bearish on a stock. So you would sell a call credit spread if you're bearish, and you would do a put credit spread if you're bullish on a stock. I'm not going to go really in depth on credit spreads in this video. I'm just going to touch on them. You can learn more about them in our options courses and how to implement them, what strikes to look for and how to place a trade. But I want to just kind of touch on, kind of the basics of the concept of selling options overall, and then why you'd want to go into spreads to protect yourself more. Again, you can sell naked calls and puts, but you have to have, again, it's a time and a place. You got to have a large account and you have to know what you're doing. But if you're the average trader, like most traders, you're looking to take those selling strategies and put them into a spread. So with credit spreads, again, a call credit spread, you would be bearish on a stock. A put credit spread, you would be bullish on a stock. So some of the benefits of credit spreads is direction, right? You have to be less directionally biased. You don't have to be, whereas if you're buying a call or buying a put, you have to be really solid on your direction as an options buyer. You need that stock to move in your direction. When selling credit spreads, you still want to be, get that direction right overall, but the stock can still trade sideways and you can still make money and have a profitable trade. So it's less directionally biased with a credit spread. Also, you limit your risk, so your break-even levels are lowered, and you also cap your losses, so there's a lot less you can lose. So, when you enter into a credit spread, you're not going to see the losses that you would make if you're just selling a naked call or selling a naked put. And it also requires less capital, so less money to enter into the trade. Now, a couple of the negatives are it limits your gains, so you can't make as much with credit spreads as you would selling naked options. And margin, you can't trade in a cash account, so you need a margin account to trade spreads, and it does require more capital. So again, selling credit spreads, they have their positives and negatives. There's more positives than negatives, and way more positives. Obviously, if you're taking a selling strategy and putting it into a credit spread rather than just selling naked. So here's an example of a credit spread. You'll see there's a combination of selling a call and buying a call. This is a call credit spread, so this would mean that you're bearish on a stock. Put credit spread would mean you're bullish. So as you'll see in this example here, you're an options seller, and you'll see the max profit is lower than selling naked in and of itself, just selling a call. However, you can see the max loss is way less. So on this trade right here, the max loss would be $328. So yes, your gains are capped, but also look at the huge amount of protection on your risk. The amount of money you could lose just selling naked is astronomical. That's why you put it into things like a credit spread to limit your risk. So while the profits are capped, you're also maxing your losses and making them much more reasonable. And it's also important to remember, yes, there are ways to trade options where there's unlimited profit potential, but realistically, you're not going to get that unlimited profit potential, right? A stock is only going to move so much within a specific amount of time. So that's why it's better to protect your losses and limit your risk rather than getting greedy and trying to hit home runs in your trades all the time. So to sum it up with selling options, it's important to remember that every options strategy requires both a buyer as well as a seller. And there's a time and a place to sell options as well as buy options. But just like with any trading strategy, you must know your why and why you're entering into each trade.